What's the largest real estate deal to hit San Francisco since the pandemic? And what does it mean for the future of office space in the city? Welcome to the Commercial Real Estate Insights podcast. I'm your host, Steve Hamoen. Let's get right to it. Flynn Properties, in partnership with DRA Advisors, has successfully closed its $170 million bid for Market Center, marking the largest real estate transaction in San Francisco since the pandemic began. This acquisition is being viewed as a significant move in the city's commercial real estate sector, particularly for office spaces. The Market Center deal is seen as a pivotal moment for San Francisco's office market, which has faced challenges in recent years. With this acquisition, Flynn Properties aims to revitalize and transform the complex into what is being described as the most fun office opportunity in San Francisco. This ambitious plan could potentially attract new tenants and breathe new life into the city's office landscape. This development holds particular significance for investors and developers who have been closely monitoring San Francisco's real estate market. The successful closure of such a substantial deal may indicate a renewed confidence in the city's potential for growth and recovery post-pandemic. For those of us observing from the Kitchener-Waterloo, London, and Cambridge areas in Ontario, this deal highlights an intriguing comparison. While the San Francisco office market sees a major investment, these Ontario cities continue to focus on multifamily and industrial developments, which have shown resilience and growth potential in the current economic climate. In contrast, the American market, particularly in tech-heavy cities like San Francisco, appears to be making a strong push towards revitalizing office spaces. This cross-border perspective underscores the diverse strategies being employed in different regions in response to evolving market conditions. Savills has forecasted a rise in retail investment as rent hikes in certain markets lure investors back. According to their latest analysis, the retail real estate sector is witnessing renewed interest globally, particularly as retailers begin to expand their store networks once more. This trend is contributing to the resurgence of rental growth across various prime retail markets, thereby attracting significant investor attention. In the United Kingdom, the first quarter of 2025 saw a notable 39.2% increase in high street shop investments, reaching £524 million, which is approximately $707 million. This figure marks a significant rise compared to the first quarter of 2024. Additionally, shopping center investment volumes reached £2 billion, or around $2.7 billion, annually in 2024, the highest level since 2017, and well above the annual average of £1.3 billion, estimated to be $1.75 billion, achieved over the past 8 years. Savills, through its Impacts Thought Leadership program, has highlighted that several factors have posed challenges to the retail sector globally. These include the rise of e-commerce, impacts of the global financial crisis, the COVID-19 pandemic, a cost of living squeeze, extreme weather events, and geopolitical uncertainties. Despite these challenges, the sector is showing resilience, with investors keen to capitalize on the emerging opportunities and rental growth. In Nashville, a significant development is underway as demolition is set to commence on an East Bank site near Oracle's future campus. Developers have secured a key permit paving the way for the construction of a hotel tower. This project forms part of a broader trend of revitalizing urban areas and capitalizing on the proximity to major corporate campuses. The strategic location near Oracle's campus is expected to attract both business and leisure travelers, potentially boosting the local economy and transforming the East Bank into a vibrant hub of activity. This development in Nashville mirrors trends seen in urban centers across North America, including cities like Kitchener-Waterloo, London, and Cambridge in Ontario. In these Canadian cities, we observe a similar push towards mixed-use developments that integrate hospitality with commercial and residential spaces. The focus remains on creating dynamic urban environments that are attractive to both businesses and residents alike. Such initiatives are not only reshaping cityscapes, but also impacting local real estate markets, providing new opportunities for investors and developers. As Nashville's East Bank undergoes this transformation, it highlights the cross-border relevance of urban redevelopment strategies that are becoming increasingly prevalent in today's real estate landscape. In the logistics real estate sector, there is a notable shift as landlords are gaining more leverage, which could have significant implications for occupiers, investors, and developers. According to a report from Cushman and Wakefield, this shift is being driven by reconfigured global supply chains and evolving cost pressures. The report, which draws insights from over 120 markets worldwide, suggests that the proportion of tenant-favorable markets is expected to drop sharply from 52% to just 28% by the year 2028. This change is propelled by constrained supply, robust demand, and rising costs across key inputs such as rent, labor, construction materials, and electricity. At the same time, landlord-favorable markets are forecasted to rise from 24% to 35%, indicating a more competitive leasing environment for occupiers in the coming years. Sally Brewer, head of Europe, the Middle East and Africa Logistics and Industrial and Retail Research at Cushman and Wakefield, emphasizes that occupiers should act quickly to secure current assets or plan for new facilities, particularly in markets where vacancy rates may tighten. As markets move towards more landlord-favorable conditions, confidence in the delivery of new supply may grow, provided construction costs remain manageable. In the Americas, the shift from tenant market conditions to more neutral and landlord-favorable positions is evident. Currently, 72% of markets are more tenant-friendly, but this is expected to reduce to just 23% in the next 3 years. Jason Tolliver, Cushman's president of Americas Logistics and Industrial, notes that there is a rebalancing of global supply chains, which is accelerating demand in key nearshoring markets like Mexico and the southeastern United States. This window of tenant-favorable conditions will not last forever, and for many occupiers, now is the time to act on mission-critical sites before the balance tips. The report also explores how cost pressures are reshaping location strategies. Labor costs vary significantly across regions, with average logistics and industrial wages in Switzerland nearly double the global average. Meanwhile, countries like India and Vietnam remain far more cost-effective. These disparities are prompting companies to reassess their site selection criteria, taking into account not only wages, but also energy reliability and the potential for automation. As we reflect on these findings, it's essential to consider the implications for the Kitchener-Waterloo, London, and Cambridge areas in Ontario. While the logistics sector here may not experience the same intense landlord leverage as predicted globally, the local market could still feel the ripple effects of these global trends. Comparatively, in the United States, regions like the southeastern states are seeing significant shifts due to nearshoring and the evolving supply chain landscape, offering a cross-border perspective on how these dynamics play out differently. Thank you for listening to the Commercial Real Estate Insights podcast. I'm your host, Steve Hamoen. See you on the next one.